Hello, and welcome to today's wealthmanagement.com webinar entitled How to Best Integrate Tax Planning into Your Financial Planning Process. This webinar is sponsored by the American College of Financial Services. My name is Janowski, and I am the technology editor for wealthmanagement.com. And I'll be your initial host today. In a moment, I will be turning things over to our speakers. But first, let me explain how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar, or you can resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. Clicking on these icons will allow you to open and close widgets on your screen, but will not remove you from today's event. Please note, this webinar has been accepted for 1 CE credit hour towards the AEP designation program. The live broadcast of this event has been approved for 1 CFP board CE credit hour. Investments and Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the resource list widget. And we welcome questions about our topic, and we'll answer as many as we can following the presentation. But feel free to submit yours to the queue at any time. Just type into the Q&A window on the left-hand side of your screen and hit the submit button. We also invite you to share your reactions to our presentation today. To do so, simply click on the reactions widget located on the toolbar at the bottom of your screen. Please also be aware that today's session is being recorded and will be available for on-demand viewing following the event today. Simply log in using the same URL that you are using today. All right, now let me introduce today's first speaker. Sophia Duffy is the Associate Professor of Business Planning at the American College and is a tax attorney and CPA. She is also the Program Director for the new Tax Planning Certified Professional designation that just rolled out from the American College last week and is now open for enrollment. And so with that, Sophia, I'm going to turn the floor over to you.
Great, thank you, Davis. And in turn, I will be introducing my co-host, Jeffrey Levine, Chief Planning Officer for Buckingham Wealth Partners, lead financial planning nerd for Kitsis.com, Professor of Practice, newly minted, of taxation with the American College, recipient of numerous industry awards, including the AICPA's Standing Ovation Award and Think Advisors Luminaries Award for thought leadership in advanced planning. And he is considered the planner's planner. He's best known for his ability to digest complex new information and distill it down to easily understandable and actionable insights. And of course, many of you know his unique ability to do this while blending humor with all of these tax, income tax, estate tax, and financial planning guidance that he can offer us today. So I will be posing some questions to Jeffrey, and then he will be answering, and we'll have hopefully a spirited discussion back and forth. Jeff, I'm going to start with the conversation. We've heard so many phrases thrown around related to tax planning. Why are we having this conversation today about tax planning? Why is it so important in our practice?
Yeah, I think it's a great question, Sophia. And, you know, I think it's a confluence of many things, but it starts with demand, right? There has to be demand there. And what we're seeing in a lot of the research today is that consumers are asking for tax planning guidance from their financial advisor. And I want to pause for a moment and really make sure I emphasize what I just said, that consumers are asking for tax planning guidance from their financial advisor. You know, it's one thing to just say, I'd like something, right? Like if I say like, boy, I want to go on vacation, that's one thing. If I say, boy, I'd really love my wife to plan a vacation for me, those are two very different things, right? One is I'm just saying, this would be great if it happened. The other is I'm putting the emphasis on a specific person. And just like that example, clients, if we see the research, in fact, I could share some slides here that I have in a bit on the research that shows what clients are asking for, again, from their advisors. And the biggest gap today between what consumers are asking for and what they're actually getting relates to tax planning. So part of this is driven by consumer demand. I think the other reason why we're talking about this now is the industry trend over the years. You know, when we started as financial advisors, or let's just even go back even before there was really financial advisors, we had insurance people, we had your mutual funds salesperson, you had your stock broker, right? There was one person for all of these different things that you had to go to. And then over time, people realize, like, boy, that seems like a lot of extra work. Wouldn't it be awesome if one person could sort of handle all of this stuff for me? And we sort of evolved into the financial advisor. That could be holistic, comprehensive, insert your buzzword of choice, Sophia, right? Like whatever we want to market ourselves on our website as, but you know, the quote unquote quarterback of all things financial. And this is just the natural next step in that evolution. We've really consolidated a lot of the investment pieces of that pie. And I think today, while there's still value in good investment philosophies and making sure that clients are maintaining an appropriate allocation, it's also best thought of today as kind of table stakes. You hear a lot of people call it a commodity today. I don't want to go that far because I think it's still important to do it well and do it right, but it's the bare minimum, right? It's like your entry fee into being a financial advisor. But how are you going to attract clients? It's probably not by telling them you've got access to the greatest stock, right? It's probably the breadth of what you do. And so there's a continued evolution of the industry, and that really exemplifies a trend we've seen. You know, if we go back a decade or so, Sophia, there was this movement towards robo-advisors, right? And even a fear that robo-advisors would replace some advisors, that robo-advisors would force all of us to work for 25 basis points. That hasn't happened. But while we haven't really seen fee compression to the extent that a lot of people worried, we are starting to see margin compression, meaning advisors are continuously being asked to do more, but we're not really seeing the advisory fee increase. It's if you want that same fee, you've got to add a lot more services. And so margins are being compressed more and more today in the advisory field. And implementing a tax planning approach to your practice is a great way to serve that demand and to meet clients where they are, as well as to highlight your differences between other professionals who are competing for the similar business. And I'd be remiss if I didn't add that today there's more tech available designed and specifically built for financial advisors to engage in this sort of planning. So if we go back even 5 or 6 years ago, the landscape was really blank as far as tax planning tools for financial advisors. If you wanted to do it, you probably had to use something like BNA's Tax Planner, which is an amazing tool, but really, really complicated and probably way more than most financial advisors need or frankly can handle. So the rise of new tools over the last 3 to 5 years that are designed with financial advisors in mind, the confluence of all of those things has really led us to where we are today, Sophia, which is having this discussion.
And I think it was a great point that you mentioned about the advisor serving that quarterback role or whatever we want to call it, because that's how we build relationships with our clients, right? They, like you said, they don't really care necessarily if their assets are allocated correctly, but they do care that they're able to meet their goals. And the other thing that impacts them so directly is how much I'm paying in taxes. These two things are really going to make an impact for them and enable us to build better relationships. Now, with that being said, when we talk about taxes, isn't that really the role of a tax professional such as a CPA or EA?
Yeah, you know, that's a question I get all the time. And what I always try to help people differentiate is what service are we talking about? You know, taxes is like an umbrella category, if you will. Taxes is not a specific thing. For instance, there's tax preparation. That really is the realm of the CPA, the enrolled agent, maybe the tax attorney, or even to some extent a registered tax preparer. But it's someone who is primarily looking back historically at what has already happened and saying, how do I report what you already did correctly to the government in order for you to comply with the rules? And maybe there's some elections here or there, but it's all based on stuff that has already happened. Every now and then you get a CPA or an enrolled agent who will say something like, oh, make sure to make your SEP IRA contribution this year. And that's tax planning. To me, that's not really tax planning. Tax planning is looking forward into the future, next year, the year after, 10, 20 plus years down the road, and saying, how do I, Mr. or Mrs. Client, give you the lowest lifetime tax bill. And that's one way that advisors are typically different than most CPAs. And look, Sophia, you're a CPA. I'm a CPA. You know, we can, most of our colleagues are backwards looking. They are, I hate to use the term, but they're glorified historians with numbers, right? Like they're just tracking history. When we're looking forward, to me, you know, that's why when people ask, what do you do, Jeff? I say I'm a financial advisor who's a CPA, not I'm a CPA who's a financial advisor, because I get up much more excited about influencing the future and what that looks like. And that is the realm of the financial planner. That's absolutely something the financial advisor can and should engage in. And candidly, even if you don't realize you're doing it, you're already doing it. A client comes to you and says, I want to open up a retirement account. Great. Did you have them open a traditional IRA or a Roth IRA? Why? Or did you have them put money in there when they could have put money into an HSA, or maybe they could have put money into their 401k? Why did you choose one account over the other? If you're selling stocks in a particular year, maybe for an older client, how do you make sure that you're not selling too much to kick them into the next Medicare Part B bracket? If you're looking at Roth conversions, how do we effectively, like all of these things are well within the guise of what a financial advisor can do. Tax prep and representing someone in front of the IRS on an audit or things like that, that's all something you need a CPA license, an enrolled agent's license. That is like formal, quote unquote, tax advice. That is what we're not talking about here. We're talking about integrating tax planning into the overall financial plan. And look, as a CFP, you take an income tax planning course. As a ChFC, you take an income tax planning course. There are tons of other advanced designations out there that help advisors to improve their tax knowledge. And it's not so that they could not use it, right? The whole point is to learn this because it is an expected part of your role as an advisor. You can do tax planning. And candidly, for me, you should do tax planning. To what degree, that's going to change, you know, vary to vary, business to business, institution to institution, compliance department to compliance department. But you absolutely want to be involved in discussions with your clients. And you can loop in other professionals like the CPA where you need to.
That's a great point. And going back to the CPA analogy, I always, before I came to the college, which I've been there for 12 years now, but I always said I knew how to report something like an ETF on a balance sheet, but I couldn't explain to you what they really were. So the planner is the one that can really understand how this will work within the client's overall portfolio. I do want to move forward with our questions. I was going to say, I want to move forward with our questions, but we got an interesting question in the chat that I thought before we move on. An individual asked about your comment about robo-advisors. And this is a little bit of a tangent, but how do you feel about the impact of AI as far as the ability to supplement or add value to planning services?
Yeah, so let me break that down into two distinct areas. One is where we are today, and the other is where I think we will be in the future. So first off, where we are today, AI is not ready to take this over from us by any stretch of the imagination. I recently received an email from a colleague of mine that was talking about you know, what's the maximum deduction someone could get for making a charitable contribution? They were looking to really offset a lot of income. And the individual reached out to an attorney who said, hey, if we do it this way, we can get like 80% of your income deducted. And I was like, well, that doesn't seem quite right to me, but maybe it's one of those oddball scenarios. Can you get me more information? And they followed up with an email. They said, well, here's what I found on, I'm not going to use the name, but one large language model, you know, service. And then they said, by the way, I also double checked it against this other one, these two different AI programs, the two that if you're thinking of in your head, those two, right? Like these are big companies who brought together and they completely botched the tax rules.
Yes.
You know, they said, oh, well, you have a 60% limit for the amount that you have for cash, but you also have another, you know, 30% limit for the amount that you give in property. So the 60 plus the 30, you can give enough and get 90%. And that's not how it works at all, right? These things offset one another. It would have actually been a really big disaster for that client because they would have got no deduction for the entire contribution of their property had they followed through on the AI guidance today. Now, That's today. I would not rely on it at all. Over time, do I think AI is going to become better, smarter, and give us a better ability to work with clients? 100%. But I really believe that it doesn't replace the advisor. It becomes, it becomes the tool that the advisor uses to better serve their clients. And again, if we go back, we've used robo-advisors as an example here a couple of times. It's actually the perfect example here. Because if you look at what happened to almost all these robo-advisor firms, they're almost all gone now. But the technology is not. Almost all of those firms were bought by human advisor firms who said, that's awesome technology. If we use that, our advisors would have that much more time to spend with our clients, and we could be serving them better, we could attracting more clients, et cetera. And if you want an indication of how successful you will be as an advisor, how much you will see your income rise, if you were to track kind of metrics, something with a positive correlation, it comes back to what I always refer to as TWC, which is short for time with clients. The more time you spend with clients, the more you will see your income rise. It's in those moments, those meetings, those calls, whatever it is, when the client goes, you know what, I just was talking to my friend and they had that issue the other day. Would you mind if I, gave them your information? Of course not. Like, yeah, send them to me. That would be fantastic. It's those moments. So I believe technology will continue to enable advisors to go deeper and to do more, but we are not going to be replaced. And if you're cynical and you don't want to buy any of that, I'll give you one other reason. When what hits the fan, everybody wants a human to turn to blame. Nobody wants to turn to the software that they chose because they only can point the blame inwards then. So I do not believe that advisors, we are going anywhere, and technology will just continue to empower us to do more and better work for our clients.
Yeah, I agree. And on the attorney side in me truly believes that you really can't serve your clients in a fiduciary capacity without using technology now. I mean, this really adds a lot of value to our practice. So back to the discussion that you had before and the comments you were saying about how advisors really should be incorporating tax planning. We know that there are limitations though, right? So aren't there rules preventing advisors from giving actual tax advice? And how do they draw that line between advice versus planning?
Yeah, that's another really good question. It kind of dovetails exactly into what we were talking about. And the first thing I will say is the ultimate arbiter of this for each and every advisor is their compliance department, right? Because what you can do, let's say legally, and what your firm will allow you to do are often different. And firms have to make different choices on what they feel, they're comfortable with, the risk versus the reward, what they have, in lots of instances, it's what their E&O policies state they can or cannot do. So I think what I would first do is make sure that people understand that legal tax advice is pretty limited in what its nature is, right? We're talking about representing someone in front of the IRS or writing an opinion letter on something like, oh, Mr. and Mrs. Smith, based on the facts you've told me, I believe it is more likely than not that you would get this deduction or something along those lines. Those are the types of quote unquote tax advice issues that financial advisors who are not CPAs or enrolled agents also should not be engaged in. Like, that is a big red flag, no, do not do that. I don't care, what other information you have, whether you're a CFP, whether you've gone through our new tax planning designation through the American College, doesn't matter, right? That is not going to allow you to do that sort of work. But when we're talking about tax information, tax education, tax guidance, tax projections, all of that is within the realm of what potentially can be done by advisor. Again, making sure that it's okay with your compliance department. But the somewhat silly example I always use, Sophia, is a lot of the advisors on the call right now probably run financial plans for their clients. And they might change the age at which a client dies or is expected to die a little bit based on the client's health. But let's just say for the most part, they peg 95 as the age the client is going to die, because that's probably good for most of their clients. That is no more actuarial advice, if you will, than is projecting the income tax consequences of a Roth conversion this year and how much that might save over the course of a client's lifetime. It's a projection. We're not guaranteeing this. It's not saying that if you do this, this is exactly how it's going to come out. because just like the investment world, there are unknowns in the tax world. It wasn't until, in fact, as we sit here today, Sophia, we still don't definitively know the results of the election. We think we're a lot closer, but tax policy can change. There's no guarantee that the rules in place today will be the rules in place in 10 years. In fact, I could pretty much, I hate to use the word, but guarantee that they won't be the same in 10 years. They change all the time. So, with that in mind, there's so much there that an advisor can do. You are potentially able, again, bearing what is allowed from your compliance department, to use tax planning specific tools to model how different scenarios might look for a client. The same way we model how different Social Security claiming strategies might look for a client. You're saying, if you do this, here's how this might look. And then at the end of the day, those clients can take that information, can take those projections, and they can help them, they can make better and more informed decisions. The more information we give clients, the more guidance we give clients, the more education we can provide them, the better decisions they'll make. And where necessary, we can have better conversations with their other professionals. Even if you're not able to engage in the planning directly yourself as the advisor, it's something beyond either what you feel comfortable with or what your company has allowed you to do. If you have that knowledge internally, you are able to more easily communicate with the client's CPA, the client's attorney. You are more likely to get referrals for those individuals because they can see you actually know what you're talking about. And you're more likely to implement the plan correctly and efficiently and avoid the costly errors that so many others make. So there's any number of reasons really why advisors can and should be engaged in, again, whatever you want to call it, tax projections, tax education, tax information, tax guidance. If you want to leave that advice off of that, that's just fine with me, as long as we're helping clients get to good outcomes.
And a great question from the chat came in. What about the relationship aspect between the planner and a CPA? How do you engage with a CPA, for example, without stepping on their toes? Or I know in the program, you touch a little bit on how you gently and politely point out to a CPA that they may have made an inaccurate assumption or a mistake. How do you address those kinds of relationship conflicts or potential conflicts?
Yeah, I think this is, look, first off, for the first recognition is understanding that tax preparation and tax planning are two very different things. Most CPAs engage in tax preparation and that's it. Now, there are some who actually engage in tax planning. And if your client is getting that and they're getting it done well by their CPA, then maybe for that client, you don't need to do this work. You just need to be communicating effectively with the CPA who's already doing it. That's fine. But most tax preparers are not doing that forward-looking work. Here's the question to ask yourself. Does your client meet or speak with their CPA other than February, March, or April of the year? If the answer is no, they're not getting tax planning, because most of the tax planning happens closer to a now during the year than it does earlier in the year. Earlier in the year, we're doing the return. Maybe we're reviewing the return as advisors and looking for opportunities, but planning tends to get done more later in the year on average. So that's the first thing. The second thing is communicate. Let's just be professionals. Let's understand what we're all doing and what each of our roles are. And finally, it's worth noting that if you do this right and you communicate effectively, there are huge opportunities for business development. So one of the most powerful things I think advisors can do is to send what you might call a tax letter to a CPA or other tax professional each year. You know, something along the lines of, dear Mr. or Mrs. CPA, as you know, we have Joan Smith, as a common client. And I wanted to let you know about some of the important things we've done with Joan over the last year that might have an impact on her tax return. Last December, we took her RMD of $20,000 and she gave $10,000 of it to a charity as a qualified charitable distribution. Now, first thing, Sophia, before I go any further, that qualified charitable distribution doesn't have any special reporting. There's no way to know that a client did that as a CPA unless the client actually tells them, which oftentimes they forget. They only realize afterwards when the advisor looks and says, hey, this shouldn't all be taxable. You did a QCD. And then we first got to go back to the CPA who's got to amend the tax return. If you ask a lot of CPAs today, they don't even want the new 1040 work because it's not as profitable for them anymore. So you might actually be doing a CPA a huge favor by making things easy for them, by making it seamless for them, by giving them the information proactively that they need, making sure they have all the 1099s, et cetera. That's what's going to get the CPA to love you. You know, I run across advisors every now and then who say, I don't get it. I referred the CPA 10 clients and I haven't gotten any in return. I'm like, yeah, because you just referred them 10 clients they feel they have to take because you sent them there, but they don't want that business to begin with. And all you did was make a lot more work for them. You know, they said, well, what should I do? I said, save them time. Get someone like you, Sophia, or someone like me home an extra night a week to spend time with their family. Let them have a half Saturday off during tax season because you help them be more efficient so that they go to see their kid's soccer game or something like that. That's going to be the thing that sticks in their mind, separates you from all the other advisors who are referring them business in hopes of getting it back, and make you the one who actually gets the lion's share of new business.
Great. And I'm picking sort of questions in the chat that are relevant to what we're talking about now. So I apologize for I know there's so many good questions in there, but I have to cherry pick a little bit. We will have some time for open Q&A at the end where Jeff will actually go through and pick some more questions to answer. Shifting gears a little bit, Jeff, to some technical content. So what are some of the most common tax strategies that advisors can implement with their clients? And really, this is kind of broadly across all wealth ranges. What would you suggest?
Yeah, you know, I think obviously every client has their own unique situation. And if you've got 150 clients, you've got 150 different scenarios at your disposal. So, you know, trying to pack everybody into a neat little box with a bow is always difficult. But I start, whenever I get these big, broad questions, I start with, well, what are the things that are most likely to be experienced by clients? And I'll start with an easy one, death. Right? Every single client is going to die at some point. I hope it's many years in the future. I hope they all live long, wonderful, happy lives using all the retirement dollars that you've helped them generate over the years. But at some point, they're all going to meet that end and they're going to pass away. And there's a lot of good tax planning that can be done around estate planning. And now most people on the call right now probably heard the term estate planning and they went, oh, but my clients, they're not those 14 million or they're not those $28 million people. We don't need to worry about that. Those estate taxes are, I'm not even talking about estate taxes, right? Estate taxes are one element of tax planning around death, but they are not the only one. And in fact, when you don't have to worry about estate taxes, it gives you the freedom as a planner to focus a lot more on minimizing income taxes. So this might be a scenario where we're looking at clients as they age and saying, hey, you've got joint accounts. Joint accounts might be lovely for marital bliss, if you will, but they're actually really bad from a tax planning point of view, because if you live in a separate property state, like most people do, there's only a step up on half of the account. You lose a step up on the other half when the first death occurs. If you live in a community property state, on the other hand, any assets that you have that have gone down in value will actually get a step down in basis, because we always call it the step up because it's nice and sounds good, but some assets will go down. If you get a step down in basis, you've lost a loss. And that has economic value. So helping clients to deal with basis management as they age is a super important issue, again, because every client will have that. Another one, of course, now is dealing with an income tax impact of unwinding tax-favored accounts. So things like HSAs as your client ages, how do we deal with those? You know, when is the most efficient time to take dollars out of that account? A 529A or so-called ABLE account for a disabled individual. How do we deal with that? And then, of course, the big one, Sophia, is retirement accounts, right? How do we effectively take the dollars out, especially going from, let's say, a stretch period of 20, 30, 40 years where we used to spread out income over, and now compressing that for many non-spouse, in fact, most non-spouse beneficiaries, into just 10 years? That requires a whole lot of new planning to help mitigate the impact of squishing all that income into a much shorter period of time. So that's one place that I would start and say, if you haven't already looked at that, your client will die at some point. It is a guarantee. So make sure that we have done our part to minimize the income tax, not only for them, but for their heirs. Then if we look beyond that, we say like the next largest group of people, it's probably clients who are looking to tax efficiently distribute their dollars throughout retirement. And this is where I always come back to one of my favorite expressions. It's about helping clients to create the lowest lifetime tax bill. That's our goal as planners. We want to create the lowest lifetime tax bill. If you have a client who has a lot of income normally and a lot of expenses, but they just happen to be in a low income year this year, maybe they are in between retirement and in between retirement and when they start taking Social Security and RMDs, or maybe they're in between jobs for a few months, so their income is much lower. If they come to you and say, hey, look, I paid so little in income tax this year, they're probably looking at you going, boy, my advisor is going to be so happy. They're going to give me high five. You should turn to them and say, I'm so sorry you got such poor or no advice at all. Because a low income year is a terrible thing to waste. We are not trying to help clients as planners, right? Sometimes as preparers we do this, but as planners, your interest is not making today's tax bill as low as possible. That's nice, but the biggest important goal is the overall lifetime tax bill of a client. Mm-hmm. So when we're talking about, retirement taxation, it's when are we doing Roth conversions? Are we timing them effectively? Are we doing it to the right amounts? Are we really thinking about all the relevant variables? A lot of times I hear people and they say, oh, well, it's about my tax, my tax bracket and whether I'll be in a higher tax bracket down the road. Your tax bracket is important, but it's your rate that really matters. And the bracket is one little, component. It's one variable that goes in there. But if you make a conversion at 62, let's say, and you're in a little bit higher income tax bracket than you are at 63, that might sound like you should wait until you're in a lower bracket, but at 63, that might start impacting your Medicare Part B and D premiums at 65, which might outweigh any tax savings. So all of these things have to go into play. If you're married and file a joint return, is there a difference in life expectancy between you and your spouse? If there is, when you die or when your spouse dies, the survivor will likely go back to filing as a single filer, squishing those brackets down, potentially pushing the survivor into higher brackets, all of which needs to be considered. And candidly, most of the time, clients aren't getting the type of guidance in these areas that they should in order to make the best decisions. And that's why we're here having this discussion today.
And you mentioned missed opportunities, right? So missing an opportunity to utilize a low tax bracket, for example. What are some of the other biggest mistakes that you see advisors make?
Yeah, I mean, that's a classic one of, I guess what I would say is there are mistakes that create true unforced errors, and there are mistakes that result in not hitting winners, right? For like people who play tennis, right? You might miss a shot you could have hit to win the point, but you didn't, it's not out, you're still going. Well, that's one type of mistake. And then there's others that are worse, where you just, you go to swing and it's just, the ball is, somewhere in the next court.
And it's game over, yeah.
Yeah, exactly. And so one of them I'll share with you is I still see a lot of mistakes surrounding required minimum distributions. And I like to talk about that whenever someone asks me, like, what's a common area of mistakes? Because most advisors think this is super easy, that they've got it all down, there's no mistakes, et cetera. RMDs are deceptively complicated. I'll give you just one example. One of the most common mistakes I see people make is once clients reach RMD age, they're converting too early during the year. Now, normally, converting early in the year is a little bit more preferable to converting late in the year because you effectively get 1 year's worth of earnings, hopefully, right, inside the Roth, effectively tax-free. For instance, if I have an account that's a $100,000 account and I convert it January 1st and there's 10% growth, that 10% growth occurred inside the Roth, I might never pay tax on it ever as long as I follow the Roth rules. By contrast, if I wait until December 31st to convert the $100,000, I had that $10,000 of earnings inside the traditional account, and sometime either I'll have to convert more now or I'm going to have a distribution in the future from that tax-deferred account like an IRA where I will pay tax on it. So overall, converting earlier in the year tends to be the more efficient move. However, once an individual reaches required minimum distribution age, there's a rule that says the first money out of an account each year is the RMD, until the RMD is satisfied in total. And actually, we now have an even revised rule going forward for IRAs, thanks to final regulations that were released earlier this year, that say if an individual has any RMD for any of their IRAs, until they have taken all of their RMDs for all of their IRAs, you can't, like, any distributions will be considered that RMD. You might say, well, why does that matter? Because you cannot convert an RMD. So if, let's say, you have $1 million IRA that you manage for your client, and there was a $50,000 RMD for that account, and you took it. The client had another $100,000 IRA somewhere else, and they hadn't yet taken any money from that. You might think, boy, I can convert anything from my client's IRA right now. I already took their $50,000 RMD. That's not going to be true going forward under the new regulations. You have to first take an additional amount out to satisfy the RMD for that other $100,000 account, and then, and only then, can you convert any excess amounts. Because again, a very tricky rule is that the first money out is the RMD, and a corollary to that is an RMD cannot be converted. So that is a mistake I see all the time. And if you're wondering what the downside is, it means if you did that unintentionally and you put a RMD inside a Roth account via conversion, that money was not supposed to be there. That means it's an excess contribution, and it could be subject to a 6% penalty each year until we fix it. So we want to make sure that that's corrected. That's just one example of a mistake. And then, of course, we get to the other side, which is, you know, what are the times where we miss opportunities? You pointed out one, low-income tax years, things where perhaps we could have done Roth conversions in those years, or perhaps we could have done tax-free gain harvesting. I think a lot of advisors are always thinking about tax loss harvesting, but, you know, we can now, as joint filers, have like $125,000 of income and still be in that 0% long-term capital gains bracket, just counting the standard deduction. A lot of clients today, a lot of retirees don't have $125,000 of income, which means they have free space in that 0% bracket that should not go unused. So things like that, the errors of omission, where we could have, again, helped our clients to create lower lifetime tax bills, which comes back, that is our mission.
Excellent. And we do have a few questions specific to that RMD scenario that you mentioned. Do you mind if we address those now, or do you want to wait? Okay, yeah. So one individual asked, when does that new rule go into effect about the aggregation requiring total RMDs to be taken as opposed to RMDs from specific accounts?
Yeah, so the new rule that's going to aggregate IRA RMDs together, that's going to be for 2025 RMDs, but it's already a rule, and I still see mistakes. Like today, if, let's say, Sophia, let's say you managed $1 million of a client's IRA money, and I managed $1 million of IRA money separately. Today, if I had taken my IRA RMD, or if I had my client take their IRA RMD from the IRA I manage, I would be able to implement a Roth conversion with them for any of the excess amount. So using my $1 million, $50,000 RMD example, I'd have $950,000 left in the account, and they could convert any or all of that this year. Beginning next year, I can't just rely on what I have anymore. I have to look at all of the clients' IRAs everywhere. And maybe, Sophia, you're lazy and you don't want to push out the IRA RMD. And I call you up and I say, Sophia, come on, send out the RMD. Well, until you do it, or until I send out another $50,000 from my account, I cannot do a Roth conversion for that client. So hopefully that makes it clear. The rule today, which exists, the rule next year, where it's actually even a little bit more severe, where we go from voluntarily aggregating RMDs across all IRAs to basically a regime that forces aggregation across all IRAs.
Right. Okay, and hopefully that did address the couple of questions that were related to the technical aspects of that rule. There was another question that just wanted to confirm that QCDs are essentially taken out of the account before RMDs are calculated for the next year. Is that correct?
Well, I don't.
Or they're not factored into the consideration or the calculation?
Yeah. So basically, a QCD can count towards an individual's RMD for the year. So if you use, you can make this year, or going into that, you'd be able to make $105,000 worth of QCDs for the year. Now, that $105,000 is not limited to the RMD. It's that it can help offset that RMD. So, for argument's sake, if your client had a $30,000 RMD and you made a $105,000 QCD, they don't have any RMD left because you've completely offset the $30,000. By contrast, if it was the other way, right? If they had a $105,000 RMD and you took $30,000 of that and made an RMD, they'd still have $75,000 left. And of course, once something is distributed from an account, whether it goes to the client in their pocket or whether it goes to charity, it's out of the IRA and is no longer part of the balance that we would use to calculate the following year's required.
Following years, right. Okay. And another question that's popped up in the chat a few times is technological tools to use. So are there any that you recommend, or maybe you can recommend a few that you've seen planners use successfully over and over as far as being able to help with tax planning?
Absolutely. And the first thing I'm going to do is a little disclaimer to say, you know, when Holistiplan was created, I worked with the team over there and helped them to build, you know, the initial calculation engines and so forth. I still have a small amount of advisory shares of the business, so I always like to put that disclaimer anytime someone asks me. But that being said, you know, Holistiplan has very quickly become the most widely used tool for financial advisors in this area. They have a overwhelming portion of the market share, and you know, I think, you know, what they have done over there, I really, today I don't have much involvement anymore other than some occasional phone calls just to check in. But what they have done is, in my opinion, really incredible. They would be certainly one to check out. Outside of them, there's others to look at as well. You might want to look at FP Alpha. That's another program out there that that does a number of things, not just tax planning, but also helps with estate planning and insurance planning and so forth. So a little bit more breadth there. And that's another one to look at. There's Corvee, which is another one. That's Corvee, which is another one. And Tax Clarity would be yet another one to look at. And finally, there is that program I mentioned originally, BNA, Bloomberg's tax planner. It's just a behemoth. You know, the beautiful thing about Bloomberg and its tax planning software is that it has a box for everything, right? If you were like, if there was a special rule in 1972 for something sold between April 1st and April 3rd of that year, you know, during those 2 days, Bloomberg will have a box to put that sale in. So the beautiful thing is you can model just about anything. The downside is it has a box for just about everything. So it becomes very difficult for, I'll be honest, like even I do have a license to Bloomberg as well as to other softwares like Holistiplan. I'll use Bloomberg very sparingly when I can't do something somewhere else, which is very rare. But it does take, you know, even you know, someone like me who spends their life, you know, nose deep in the tax code, it can be very challenging to navigate that efficiently if you're not really familiar, like really familiar with not just tax rules, but also how it's reported and code sections, because that's often how they display those terms.
Great. And that actually addresses another question that came in earlier when you mentioned BNA being too much for advisors, and they were inquiring why that is, but I think now they understand. So for you personally, you mentioned you're often nose deep in the tax code. How do you stay abreast of all of the proposals coming out, final regulations? How do you keep up to date on all of the changing tax landscape?
Yeah, so I would say I have a bit of a problem, and it's an obsession. It really was what it comes down to. And I love going to the source. You know, most people, when you talk to them, especially most of my advisor colleagues, they, you know, you show them a little bit of the new legislation, and oftentimes my friends look at me and they look like, you know, they've completely glossed over. They go, you read it, we'll wait for your digest, and then we'll go with that. Which is, I love it. Like, I love going into the tax code and figuring out, like, I'm the type of person when there's something new, I like to think about, well, what if this happened? Oh, but what if that happened, but then this, okay, but what if this, and this? And I like mapping out all those different scenarios, almost like a mental flow chart, if you will, of how things could work out. And that's become an area that, thankfully, I've been given the privilege over the last decade or so to spend more and more of my time doing as I've transitioned away from full-time client work to focusing more on this education and thought leadership role, it's been amazing for me. But it's also been one of the reasons why we want to get a program like the Certified Tax Planning Professional Program, the Tax Planning Certified Professional, the TPCP program, in folks' hands. That was a lot of the impetus behind this was, how do we take the breadth of tax information that's out there and distill it down into a package that advisors can take in, can use with their clients, and can do so in a way that, regardless of whether they're sitting down with a high-income individual, a low-income individual, an employee, a business owner, an executive, what are the planning strategies that they should be thinking about? Not, what are the rules? The rules are important, but this is about application of those rules. So for me, I like to go to the source, but then my real passion is helping to take that source information and translate it, as you talked about almost in the intro, into bite-sized actionable pieces, whether it's through a 100-tweet-long GIF-filled spread about what the latest tax law says on Twitter, or whether it's now getting to have the opportunity to work with you and the rest of the American College team on creating the Tax Planning Certified Professional Program.
Great. And I do want to save time for the questions in the chat because there are so many good ones coming in, but I have to ask you, you mentioned earlier, we don't know the exact results yet of the election, but assuming the incoming administration is a Trump administration, he has spoken pretty often recently about complete elimination of the individual income tax. How realistic do you think that is? And if it does come to fruition, are there any planning advice or strategies that you can give today so that we can take advantage of something like that?
Yeah, we used to have very clear lines, in between our two parties in terms of how they thought about spending and the increase in the deficit. And today, it appears that those lines have blurred a bit, where,
right,
there's still stark differences between the parties, but Democrats are okay with raising the deficit via one set of provisions, and Republicans now are okay with raising the deficit, but with another set of provisions. We don't really have that fiscally conservative party. That said, there are still a meaningful number of deficit hawks inside the Republican Party, and I think there are enough of them that we are not going to see an elimination of the income tax altogether. In fact, I think the most likely outcome here, assuming Republicans win back control of the House, which at this point it does look like they will do. As we sit here, they're like 99.8% likelihood to maintain the House. So assuming they do, I think the most likely outcome is a large-scale extension of the Tax Cut and Jobs Act going into next year. And so the good news is I think we'll have that answer really soon, right? Whereas if it was a split Washington, maybe that's more, to someone's political liking. But from an advisor perspective, it would have made our lives very difficult because we probably would not have had tax certainty for 2026 until very late next year, if not into the following year. By contrast, right now, we pretty much can assume we're going to have large-scale extensions of the current tax rules. Now, some things we don't know for sure. We don't know whether they'll extend things permanently or whether it will be another law with a sunset. We don't know whether there's some talk about whether the SALT cap would remain a part of the bill. There's some talk about whether tips or Social Security or even overtime wages could become tax-free again. There's some political desire to do that, but there's also some deficit hawks within the Republican Party that could create an intra-party showdown. It's not going to stop them from moving a bill forward, but it could make those rounding out the edges of the bill, that could be a little bit different. But of course, there's also meaningful estate tax consequences. And Sophia, I turn it back to you. That's your bailiwick. What do you see on the horizon with, estate tax changes?
Yes. So, again, we don't know for sure, but it does seem likely that at least the exemptions that are in place and the exclusions and all of the essentially the doubling of, the exemption will remain in place. And what I've talked about in the last few years, particularly, is, at the federal level, what that means is that most of our clients really won't need to worry about that. Hopefully some of our clients do, because that would be better for us. But, generally, when you're dealing with clients that do not need to worry about any kind of federal transfer tax consequences, your focus then should turn more at the state level. And if we are, you mentioned earlier, if you're lucky enough to live in a state that you don't have state estate taxes or inheritance taxes, then your planning opportunities are pretty broad, right? You have a lot of opportunity to use things that would otherwise be taxable, like revocable living trusts, for example. If you live in a state that does have estate tax or taxes gifts, for example, then you really do need to determine, well, how can we lower our taxable estate at the state level? Because that really does become important. I just worked with a client who had an estate where they initially thought the individual had passed away with about $300,000 of assets. It turned out his estate was actually over $1 million when they had actually accounted for all of his assets. So unfortunately, no planning had been done beforehand to reduce the level of that tax. But I do live in a state where it's taxable. So that ended up being a bigger tax bill than they had expected. But generally, from that, I say, look first at the state level. See if, for example, does your state tax certain types of items that might not otherwise be taxable? For example, some states do include life insurance as a taxable asset and other states don't. If it is a taxable asset, then maybe we can look to things like ILITs or trusts. I think there might be some background noise somewhere. Is there anyone?
I hear that too, yeah.
Okay. So those are the types of things at the state level. At the federal level, though, if we are working with clients that do need to worry about, if they've got $14 million plus estates, if they're married and it's over a $30 million estate, for example, then we're back to really what we've been doing over the last few years, which is how can we make irrevocable transfers, utilizing our exemption now while we have it. If there is an extension, is it going to be another 7 years, or do we expect it to be something shorter, like only extending for another year or two? And those are answers that we won't have right away. But one thing that we could do is put a trust in place now, and you don't have to fund it with a lot of money. Maybe make a small gift to the trust, but that way it's in place. It's there to use if we find out the extension is only going to be for another 12 months, for example.
That's right.
That way that vehicle is sitting there and ready to use, and we don't need to worry about taking a few months, wasting a few months of our time to set that up.
For sure.
All right. Okay, great. Jeff, do you want to look in the Q&A? There were a few more questions about RMDs and then some about life insurance and annuities as well in relation to
sure. Yeah, go ahead, hit me.
All right, let's see
sure.
here.
What we got?
Okay.
And if there are other questions, now would be a good time to put them in while we think about this. Yeah.
Sure. Yeah. Okay. One person asked the proper use of the 7702 life insurance and fixed annuities for partial Roth conversions.
Well, I mean, they're really two different animals there, right? If we're looking at, effectively, if you have money in the life insurance policy, it's not part of a Roth conversion because a Roth IRA, just like any IRA, can't hold life insurance, and there's no way to put a retirement account inside a life insurance policy. So there are two different things. But if the question is more along the lines of, what do you think about life insurance versus a Roth conversion? I think it's a fair thing to consider, just like any other tool, right? If we say like, well, Jeff, what about a hammer or a screwdriver? Like, they're both wonderful tools. What do you have in front of you, a nail or a screw? And I will, I'll give you an idea of which one I think would probably be the better tool. To me, if we're looking at for the next generation, if we're looking at providing tax-free legacy to heirs, what I would say is outside of the investment part of this, right? Because life insurance might have sort of a built-in, if you will, investment return, obviously based upon when the client dies. But if it's a guaranteed policy, you might say, Mr. and Mrs. Smith, if you live to 95, it's a guaranteed 5% IRR. So there's a guarantee associated with the investment component that may not be available with outside investments. But if we're looking purely from a tax perspective, then what I often say is if the client would have an estate tax, either at the federal level or perhaps even at the state level, as Sophia was talking about, then looking at a life insurance policy can sometimes get a little bit of a boost, if you will, because when we're using the life insurance policy, we can take the distributions from the retirement account, pay tax, and then gift those dollars outside of the estate, where the life insurance policy and its growth and its death benefit will all be outside of the estate, not subject to estate tax. But of course, the death benefit would still be income tax-free. So if there's a taxable estate issue, again, either federally or at the state level, then I can sometimes lean a little bit more towards a life policy for legacy purposes. If we're looking instead towards utilizing a life policy, if we're looking at a situation where there is no estate tax, then I often lean towards the Roth IRA as being the better tax vehicle. You might say, why? And it comes down to the fact that when someone dies, the death benefit associated with the life insurance policy is tax-free, right? But if they die and they leave a Roth IRA, then it's not just that amount that is tax-free, but it's that amount plus often 10 years worth of growth. If you can manage 7% returns for 10 years, you can double an account, and $1 million amount left to an individual can become worth $2 million. Now, if you say, but hey, the life insurance could be worth that much more well, now it's, again, you're going back to an investment decision there. So it's a combination of both tax and investment expectations. But if we want to isolate taxes, then again, to simplify, if there's an estate tax issue, you can lean a little bit more towards, I think, the life insurance policy and shift money out of the estate. But if not, I look to the Roth IRA as the preferred vehicle, because it's not just the death amount, it's the amount that is left at death plus 10 years of tax-free growth. And
then we mentioned the inability to convert an RMD directly to a Roth, but as someone asked, if the client has RMD and puts it in a taxable account, can they then contribute that to a Roth?
So they can, that's a great question. So I guess what I'm getting at here is, okay, they took their RMD, we're not doing a conversion, but now this money is sitting in their bank account, can they use it to fund this year's Roth contribution? The answer to that is, provided they have compensation, sure. Because once you take the money out of your IRA or your Roth, like whatever it is, once it's out, it's regular money. You can do with it whatever your little heart desires.
Pay taxes on it at that point, right? Yeah.
That's exactly right. Right. It's just regular money, no different than if you had bank account money for 100 years. But in order to make a Roth IRA contribution, two things need to be true. One is you need to be below the income threshold, so that would have to apply to your client, and your client needs to have compensation, which is generally earned income, W-2 wages or self-employment income. There are some other ancillary things, but it does not include Social Security. It does not include IRA distributions. It does not include interest, dividends, or capital gains. So if there's no compensation, it doesn't matter what other income your client has, they cannot make the contribution to begin with. So at this point, we'd be talking about, at minimum, someone who's 73 years old, so they've got RMDs, but they're still working, again, in order to make that contribution.
That's a very good point. I think we might have time for one more question, and then Davis, I know we'll need a minute to wrap up, but there were some questions asking for clarification on the inherited IRAs and how that relates to the RMD. So in relation to calculating total aggregate RMDs, does that all need to include from inherited IRAs as well before we can do a Roth conversion?
Gotcha. So an individual's own retirement accounts are separate. So the way, separate from any inherited accounts. So the way to think about this is all IRA RMDs have to be satisfied for your own owned RMDs. Then when we look at other things, other plans like 401ks or governmental 457 plans, the general rule there is no aggregation at all. So if you have clients that have 3 different 401ks, they actually have to take a distribution from each of those 401ks, but we never aggregate across a client's own accounts and their own inherited accounts. In fact, if you inherit an account from different people, you can't even aggregate those. So if I have one inherited IRA from mom and one inherited IRA from dad, I actually have to keep those separate in separate accounts, and the RMDs need to come out separately and they need to be calculated separately. We could go on and just, Sophia, I have a hour-plus discussion that I do with folks just on RMDs. And the number one comment at the end of the hour is always, my goodness, I did not realize how much about RMDs there was to know before I went through this hour. And indeed, there's so much like this elsewhere. And that's, that brings us back to, just one final point here, which is why you, I, and the rest of the American College team have worked so diligently for the last year plus behind the scenes, putting together this tax planning certified professional course that has gone live now, is available to students. And I just want to let everybody know, if they're on this call listening live, that there is a limited time before the end of the year, if people act, Correct me if I'm wrong, Sophia, but I believe it's Tax Plan 24, right?
That's right.
That's right. So if anybody is interested in that and they use that code TAXPLAN24, they'll be able to get a significant discount here and be also one of the first students to go through this program along with their peers. So
Yep.
I know my time is up, Sophia. I could do this all day. I love this. But back to you.
Yeah.
Thank you, Sophia, for the discussion.
I know Jeff, you've mentioned that you could just do an hour-long Q&A where people just shoot questions at you. And based on the ones in the Q&A here, I think we easily could have filled the hour. So I do apologize to all of those of you who we didn't get to your questions. Thank you so much, Jeff. This has been a wonderful discussion. It's always a pleasure. And I'll turn it back over to you, Davis.
Thank you, Sophia. Yes, absolutely incredible job, guys. And I do a lot of these, and I can tell this is a very, very popular subject just because of the number of questions that have come in. And just for the audience to know that the speakers and the American College will, in fact, get those questions. So not to worry. And anyway, I would like to thank Jeffrey Levine and Sophia Duffy for their very outstanding presentation. We'd also like to thank the American College of Financial Services for making today's webinar possible. Once you leave the event, a short survey will pop up in your browser window. We'd appreciate it if you would share your feedback on this event, as it will help us to provide you with content that is most interesting to you. This is a great example of such content. On behalf of wealthmanagement.com, have a great rest of your day.